The US Federal Reserve raised interest rates again this week by a 1/4 percentage point, and the UK is expected to follow suit when the Bank of England meet in a few days to try and tackle the stubborn inflation problem. And while interest rate hikes are really hurting people that need to borrow money or spend on credit, higher interest rates have made saving money in a bank account fashionable again. Gone are the gloomy days of the last 12 years where it was totally normal to see savings accounts offering measly lows of 0.1% interest. You'd be secure in the knowledge that your money was being stored in a safe place as opposed to underneath your mattress, but in reality your money was just rotting away to inflation. Fast forward to today, the Bank of England base rate has jumped a whopping 13 times since the end of 2021, and as a result most banks have followed this upward trend with higher interest rates for savers. I don't know about you, but I've definitely seen an uptick in banks marketing the interest rates on their savings products, and there are even accounts where you can earn up to 7 or 7.5% interest if you're an existing customer. The norm for a typical savings account at the moment, though, is around the 4.5% mark, and that may increase further if the Bank of England goes ahead and increases the base rate as expected. With savings accounts looking more attractive than they have done in over a decade, you might be asking yourself whether it's time to do away with investing and all the rest that comes with it and just stick your money in a savings account. I mean, why not? It's not like investing in the stock market has been plain sailing. 2022 was probably a year most investors would rather forget, with major indexes like the S&P 500 down by over 19%, its worst year since 2008. So with all this in mind, are we better off financially saving our money in a traditional savings account, or is investing in the stock market really the way to go? Now, before we get into the nitty-gritty, I do want to say that whether you save or invest your money should always be commended in most cases. I think any attempt to make your money work harder for you, whether that be through bank interest or stock returns, should always be applauded, because recent stats show that nearly a quarter of people in the UK have no savings at all, and of the people that do save, just over half of them do not have enough to live off their savings for more than a month. Therefore, anything you can do to help cushion against future financial pressures is great if you have the means to do so. Even hiding wads of cash under your bed doesn't seem so bad compared to the alternative of having zero cash saved. Even with this being the case, there's no disguising the fact that money in the bank or under your mattress cannot hide from the dreaded I word, inflation. Now, according to new research released by Lloyds Bank earlier this month, 29% of Brits still don't understand the term inflation, and 6% have never even heard of it, despite the widespread media coverage we've seen over the last few years. I have talked about it in previous videos, but inflation is the magical process by which the cost of goods and services rises, and as a result, your ability to buy the same goods and services at the same unit cost decreases. Essentially, inflation chomps away at the purchasing power of your money. And this is especially true when, as you can see in this graph by the Office for National Statistics, wage growth isn't keeping up with rising inflation. You're getting paid the same amount, yet the price of goods and services keeps on increasing. So while interest rates or savings accounts might give the illusion that your money is increasing in value, inflation is actually causing your savings to lose value in real terms. Say you opened a top instant access savings account, which currently has an interest rate of around 4.5%. It's all very well focusing on the 4.5% return and seeing your money grow over a year. But if inflation is running at 7.9% like it is today, then your real rate of return is actually minus 3.4%. You'd be able to get a better rate if you were willing to lock your money away for a year in a fixed term savings account, but still not enough to beat current inflation rates. According to a recent analysis by Finder, the average savings per person is a little under £17,800. If that amount were put into a standard variable ISA in May 2013, it would have effectively lost over £4,000 in real terms by May 2023 in the last year alone. Research by the investment platform AJ Bell shows that collectively as much as £113 billion could have been wiped off the value of UK savings as a result of inflation invasion. Now, the chart I'll pop up on the screen now shows just how much your savings would need to grow just to break even with inflation during this time period. If savings rates had tracked the level of inflation, then the £17,000 odd deposited in 2013 would be worth over £23,000 in May 2023. So you can really see how increased interest rates for savings account are just a fallacy if inflation is tracking higher than the interest rate you're getting on your savings account. You might be wondering whether saving your money can ever beat inflation, and technically yes, it can. In fact, from the mid-1980s up until the global financial crisis, the real rate of return for savers was positive, meaning they were making more in interest compared to what was being eaten away by inflation. It's only since the GFC in 2008, when bank rates plummeted to near 0% levels in the UK and most other global economies, including the US, that saving money made no sense at all, because of the rate at which inflation was and still is outstripping interest rates. But as I mentioned in the intro, the alternative route of investing hasn't exactly been an easy ride either, with 2022 being a terrible year not only for the stock market performance, but the bond market as well. The beloved S&P 500 finished the year down by 20%, the Nasdaq was battered by a 33% fall, and the FTSE 100 pretty much finished the year where it started. But despite the turbulence we've witnessed recently, history suggests that investing in the stock market is a reliable way to grow your savings over the long term. If we take the average annual return of the FTSE 100, for example, at 7.3% over 30 years, this outperforms the average annual growth in inflation of 2.1% over the same period. With the S&P 500, you'd attract an even higher rate of return at 9.9%. Obviously, these are just averages, and in some years the market might return more than average, and in other years it returns less. The key things to note when looking at whether saving or investing is the right fit for you are that firstly, the stock market is geared towards a long-term investment horizon. Ideally, you want to be investing money that you won't need for at least the next 5 years. Secondly, investing in the stock market does not come without some level of risk, and of course the hope is that you'll be rewarded for increasing your exposure to risk if you favour investing over saving. When investing, we're all warned about the danger that the value of our investments can go up as well as down, and that past performance is never an indicator of future results. Saving, on the other hand, is a double-edged sword. On the one hand, you know what return you're going to get and when. If you opt for a savings account offering a 6% interest rate, you're pretty much guaranteed that return for however long the offer period is, depending on the type of account. Yes, there's a possibility that the bank could collapse, but savings are usually protected by government compensation schemes up to a certain limit, like the FSCS in the UK and SIPC in the US. With savings, you're getting a low risk, if not a guaranteed return with virtually no hassle and the extra bonus of protection of your money by the government. On the flip side of the coin though, saving doesn't allow you to capitalise on opportunities and potentially increase your return in the same way the stock market does. When you invest your money, there's no limit to the return you could get in any given year, unlike saving your money where you're limited to receiving a fixed rate of interest. So if we take a look at the S&P 500 index as an example, you'll see that for most years since 1926, this would have given you double-digit returns on your money. Now, I appreciate not everyone has a 96-year time horizon.
Yeah, she's over 100 years old.
But even looking at data from the last 15-16 years, 11 of those years were double-digit returns, coming nowhere near the interest rates offered on savings accounts. So for investing to work out for you, not only do you need to be comfortable exposing yourself to more risk than you would with a savings account, but you also need to be able to give your investments time to generate those juicy returns. This doesn't mean dipping in and out as and when you see a bit of volatility in the market. It literally means leaving the money you're regularly investing alone to grow and compound. And of course, this is providing you've done your research and you're invested in good quality stocks or funds. History shows that the longer you invest over many years, the increased chance that you have of achieving better returns. And that's not to say the journey will be a completely linear one. The stock market goes through cycles of boom and bust periods, but history shows that the general trend is an upward one. Now, it's still possible to do well in the short term with investing, but there's a higher risk of also doing really badly as well. When you look at saving, then the inflation threat is really the only downside to that strategy because you already know what you're going to get out the other end. Saving interest rates are locked in and don't change invariably at the whim of an external factor like they do with investing. In saying that, we have absolutely no idea whether saving or investing might be the best route. Nobody has a crystal ball to tell us what levels interest rates will be, what market returns we can expect, and how inflation will affect our returns in any given year. Whether you're saving or investing, the power of compound interest is really a benefit of both options. Compounding is what happens when the interest or profit you earn on your originally saved or invested money is continually reinvested, earning you even more money in return. And it's really important because ultimately it's compounding that feeds the growth of your investments over time, rather than your money that you drip feed in yourself. Given time, investments and savings can both work to compound our returns. Even getting 6% per year with a savings account will add up over time as you start earning interest on top of the interest you earned from the previous year. And the same is true for any returns you make in the stock market. As the cost of living crisis has motivated people to make their money work harder, investing has seen a surge in popularity in the last few years, with 2 in 5 or 42% of Brits investing in 2023. This is up from 36% in 2021. If you're confused about whether you should invest or save, the route that's best for you all depends on your own appetite for risk and what you're able to stomach when it comes to uncertainty around your returns. I'm certainly no financial advisor, and personal finance is all about what's personal to you and your situation. If the thought of never knowing when you'll be back in the green after years of seeing red gives you extreme anxiety and keeps you awake at night, then it's definitely worth looking at whether other strategies like high interest savings might be a better option for you, especially if your risk tolerance is really quite low. Alternatively, if you have a shorter time horizon and know that you will need access to your money in the next couple of years, then a savings account or something similar like premium bonds might be more sensible. There are some decent deals out there at the moment, and it's likely more products will be introduced to the market if the Bank of England increases the base rate again this coming week. You might not be able to beat inflation if you go down this route, but it's way better than doing nothing with only a guaranteed loss to show for it. If you are keen to maximise your returns and you're comfortable playing the long game by investing regularly over 3 to 5 years at a very minimum, then investing might be a good option for you to consider. Ultimately, that's something you have to decide based on your preferences and future goals. Your situation is always going to be unique to you and your own circumstances. Also, there's no reason why you can't do both and allocate short-term expenditure to a savings account while also having an investment pot that you regularly invest into for your medium to long-term goals. It's commonly accepted that the best chance of beating inflation is to invest in assets of some kind. So if you're new to investing, feel free to take a look at the beginner investing video I did here, or if you want some idea of other assets you can invest in as an alternative to stocks and shares, then check out this video here. Thanks so much for watching, and I will see you in the next video.